Most of the beginners start investing with this question: how fast and how far will this stock's price go up? But that's the wrong question. The price of a stock is not its real value. The price is just a mix of investor emotions like expectations, greed, fear, biases, ego, even euphoria. It tells us nothing about what the stock is truly worth. That's where value investing comes in. Once you understand value investing, you invest with conviction, and your results improve automatically. Margin of safety principle. The foundation of value investing lies in the margin of safety. In simple words, it means buying a 100 rupee asset for 50 rupees. Let me explain with an example. Imagine you're at the gym. You can bench press 200 pounds, but only once. That's risky. You'll definitely ask for a spotter because if the bar crashes, you could be badly injured. That's high risk, no safety margin. Now think about pressing 100 pounds instead. You can do it easily, no spotter needed. Even if something goes wrong, the injury will be minor. This is low risk, high return. That's what margin of safety is all about. Biases in our brain. Now here's the problem. Our brains are full of biases. We grow up with fixed ideas and thoughts that stick in our minds. So even if you're shown facts that challenge your beliefs, you often reject them. For example, most people believe the stock market is too risky. Even if I give you 5 solid facts proving otherwise, many will still ignore them. That's how investors get trapped in their own biases, seeing everything through the lens of their fears. So when the stock market crashes and shares are available at very low prices, what happens? Instead of buying, investors panic. They fear prices will keep falling and hesitate to buy at the right time. But here's the funny part. The same people, when they see a sale in a store, rush to grab items as fast as possible. That's the difference between being driven by emotions and investing with logic. Most people jump into the stock market with half-baked ideas. Investing isn't about luck or shortcuts. It's about understanding the right principles and applying them with discipline. That's exactly what the book Investing Decoded is all about. It's a guide designed especially for beginners, explaining investing in simple and practical ways. Before you put your hard-earned money at risk, you need to learn the basics that actually work. And that's what this book is all about. In the world of investing, there are few words that sound as exciting as multi-bagger stocks. A multi-bagger simply means a stock that grows multiple times its purchase price. A 5-bagger grows 5 times, a 10-bagger grows 10 times, and so on. These are the rare gems that multiply your investment many times over, the kind that make stock market investing truly rewarding. But where do these multi-baggers come from? They mostly come from the equity markets, where thousands of companies are at different stages of their journey. But spotting them early is where the real skill lies. They usually start small, often in the small cap space, where there's little research, no media hype, and very few investors paying attention. The best multi-baggers share some common traits. They trade at low valuations when nobody believes in their potential. They show signs of improving performance, maybe a sudden surge in profits or a new growth plan. They often rise from turnarounds. Companies once struggling, now taken over by stronger managements. Think of stories like CG Power, which rose from 6 rupees to over 300 rupees, or Avanti Feeds, which defied expectations to deliver massive gains. Even giants like Eicher Motors, Asian Paints, and Bajaj Finance started out as quiet performers before taking off. Sometimes entire sectors can turn into gold mines like IT companies during the COVID era, or banks in recent financial booms. When the tide rises, it lifts all boats, and many multi-baggers are born. And then there are the steady compounders. Companies like HDFC Bank, TCS, and ITC, they may not double overnight, but over years, their consistent growth quietly compounds into extraordinary returns. That's the essence of a multi-bagger: patience, value, and timing working together. Because sometimes even a single multi-bagger can change your entire financial future. So the real question is, are you ready to spot your next one? Let me give you some insights on the book so you know exactly what it is. First, equities should be at the forefront. Most investors in India put their money first into fixed deposits or real estate. Stock market usually come at the last on their list. But here's the truth. Stocks represent real companies doing productive business activities, and over the long term, these companies generate far better returns than FDs or property. That's why equity investing should be at the forefront of your portfolio, not the bottom. Second, common sense is more important than IQ. You don't need to have a very high IQ to generate returns in the stock market. What you need is patience, discipline, basic common sense, and the ability to act decisively when opportunities appear. Business schools often overcomplicate investing with formulas and theories, but in reality, the real battle is against human emotions like fear, greed, and ego. Third, stock market risks are overstated. Many people think investing in the stock market is too risky. But let's compare. Starting a new business is far riskier. Why? Because it's untested, uncertain, and may fail completely. On the other hand, when you buy stocks, you're investing in companies that already survived, built, and fine-tuned their business models to be listed on the stock exchange. So in many ways, stock market investing is actually safer than starting a business from scratch. Fourth, capital markets outperform. The stock market has the power to generate returns that can even outperform your career income or your business income. Why? Because some companies can expand exponentially, not just in India, but also to foreign markets. When that happens, the growth translates the investor's investments into life-changing returns. Fifth, parallel income. Stocks don't just give capital gains, they also provide dividends. And dividends increase with time as companies generate larger cash flows. Equity returns can increase larger than career incomes. It's like creating a parallel income stream for yourself. So while your job gives you a salary, your stocks quietly keep paying you too, and often grow you faster than your career income. Sixth, embrace risk and volatility. Value investing is not about avoiding risk. It's about accepting the volatility of the market and taking advantage of these wild fluctuations. Stock markets will always go up and down, but for a smart investor, these ups and downs are opportunities, and he takes complete advantage of these opportunities. When fear takes over and prices fall, value investors see stocks available at below fair value, and that's when they buy. So volatility isn't the enemy. It's your best friend if you know how to use it. And last, simple mindset shift. At the end of the day, the big shift is this. Stop thinking of stocks as gambling tickets. Start seeing them as ownership in real businesses. With the right mindset, patience, and discipline, the stock market can become the most rewarding investment avenue of your life. So these were some of the most important lessons from Investing Decoded. To conclude, the stock market is not gambling. It's about businesses, discipline, and smart decision-making. And if you want to build wealth with confidence, you need to first understand the game you're playing. Investing Decoded gives you the mindset, the tools, and the clarity to invest wisely. Read it, understand it, and only then invest. Because the best investment you can make first is in your knowledge. The book is available on Amazon, Flipkart, and other marketplaces. Take the first step to investing now.